Siemens is no longer being valued like an old industrial conglomerate. The market is starting to price it like a high-margin industrial software platform with exposure to electrification, AI infrastructure, automation, and recurring digital revenue all at the same time. That is a huge shift. The problem is that the stock already reflects a lot of that optimism. Siemens is no longer a turnaround story. It is now an execution story. And at this valuation, execution has to stay nearly perfect. The latest quarter showed exactly why investors are getting more aggressive on Siemens. Organic revenue grew 6%. Order intake jumped 18%. And the digital industry's margin exploded higher by 370 basis points to 18.5%. That matters because software is becoming a larger part of the business mix, and software margins are structurally better than traditional industrial equipment. Siemens is also benefiting from strong demand tied to electrification, semiconductor manufacturing, and data center infrastructure. Cash flow volatility still exists because of acquisitions and portfolio restructuring, but the overall direction is clear. Siemens is becoming less cyclical, more digital, and more recurring. This is not a cheap stock anymore. Morningstar's fair value estimate is €240, while the stock is trading around €265, meaning investors are already paying a premium for future execution. The current valuation only makes sense if Siemens keeps expanding margins, successfully integrates expensive software acquisitions, and maintains high single-digit earnings growth for years. The market is no longer valuing Siemens based on what it is today. It is valuing Siemens based on what it could become. That is a very different risk profile. The entire strategy is built around one idea: merge industrial hardware with software and create an ecosystem customers cannot leave. Siemens wants factories, buildings, electrical infrastructure, rail systems, and even hospitals running through its digital platforms. That is why the company spent aggressively on software assets like Altair and Dotmatics. Management understands that pure industrial hardware businesses eventually become cyclical and commoditized, while software creates stickier customers, recurring revenue, and much higher margins. Strategically, this makes complete sense. But it also means Siemens now has to prove it can behave more like a software platform and less like a traditional conglomerate. Siemens competes with Schneider Electric, ABB, Rockwell Automation, PTC, Dassault, Autodesk, and even specialized AI infrastructure players. The company's biggest strength is breadth. Very few competitors can combine industrial automation, electrification, software, mobility, and healthcare infrastructure under one ecosystem. But that same diversification is also its weakness. Schneider and Vertiv have more direct exposure to the AI data center boom. Pure software firms are often more focused and faster moving. Siemens wins on integration and scale, but sometimes loses on simplicity and narrative clarity. The biggest risk is that Siemens overpays for growth that never fully materializes. The company is spending heavily to build its industrial software empire, and expensive acquisitions always carry integration risk. There is also a hidden issue inside the bull case. Siemens does not have the same concentrated AI infrastructure exposure as some competitors, meaning investors expecting explosive AI-driven growth could end up disappointed. On top of that, this is still a global industrial company exposed to manufacturing cycles, tariffs, China demand, and execution complexity across multiple segments. If growth slows while the valuation stays elevated, the stock can re-rate downward very quickly. The upside scenario is powerful if management executes correctly. Siemens could become one of the few companies sitting directly at the intersection of automation, industrial AI, electrification, smart infrastructure, and industrial software. If recurring software revenue keeps rising and margins continue expanding towards software-like economics, the market may eventually stop valuing Siemens as an industrial company entirely. In that world, today's valuation may actually look conservative. The real bull case is not just higher revenue. It is a permanent re-rating of the entire business model. This is not a deep value industrial stock anymore. Siemens is becoming a premium quality industrial technology platform, and the market already knows it. The company has a real moat, strong positioning, sticky customers, and exposure to several long-term growth trends that probably last for decades. But investors need to understand what they are buying. This stock only works if Siemens successfully transforms itself into a higher margin software-driven ecosystem without losing operational discipline along the way. The future looks strong. The valuation already assumes it will happen. I'll break down the next one soon. Subscribe if you want to stay ahead.